All right, good afternoon. I'm pleased to present and welcome Sheel, who's the founder of Better Tomorrow Ventures. Now, Sheel is a serial entrepreneur, has built and sold multiple companies. And I always enjoy talking to entrepreneurs turned investors because I think they're actually probably the best investors. You know, you're a crossover hybrid between investor and operator. So it gives really unique perspective. We're going to touch on a few different topics. One is we got to get in the spat you had with Chamath days ago around his DPI. I saw that online and I DM'd she. I was like, hey, we got to get you on the show and talk about this. So it's good to be timely. We'll spend a minute or two on that and then talk about the state of venture overall, how AI transforming the entrepreneurial startup ecosystem, where you're seeing certain themes and trends, how LPs are responding in the current climate. You also backed some very notable startups, including AngelList, and that's transformed investing in a couple different ways. I'd love to talk about that. I think one of the advantages of talking to people that have a unique perch in different asset classes, you can see the cross connects. There's always some relationship, eventually links back to QQQ or bonds at some point. So first off, thanks for joining us. How have you been?
Very good. I spent the last few months in New York. We have a lot of companies there. It was great. Now I'm moving on. I'm actually home in Pittsburgh right now.
Well, you were a Carnegie Mellon grad.
That's right. And my parents live here, so I'm visiting them for a few days.
Great program, and that I imagine set you on the trajectory that led you to where you are today.
Yeah, absolutely. I had such a great experience there. It was awesome. Highly recommended for anyone who's thinking about sending their kids there. It was a great experience.
Are you of the view that computer science degrees are no longer of value given where AI is trending, or no?
No, it's a great question. I think it's always going to be valuable to have that skill set, but I think the great computer science programs are evolving, and it's the same way that a computer scientist from 30, 40 years ago, like my mom, who learned in punch cards, like what they were learning didn't apply. Actually, it was probably more like 50 years ago, and what they were learning didn't apply to the next generation. So it's always an evolution, and I think the same is true today.
Fair enough. Fair enough. At the very least, you learn critical thinking, problem solving.
Exactly. Logic.
That's extraordinarily valuable. So let's start off with kind of the recent drama of the day, and then we'll zoom out a bit and talk about venture and AI dynamics and tech more generally. But so, this was a post that, oh man, it's got to be a compliment. It's got to be a compliment called a buffoon from Chamath. This is the guy that was talking about buying CDS on bank stocks and never made any sense to me. Bank stocks are doing more than well. So why don't you frame up what's at issue here and what is the dispute around the DPI? Yeah.
Well, so the main thing, there's point one, which is DPI versus TVPI, and I think he has a perfectly valid point that DPI is the only thing you can count on. TVPI can be manipulated. Now, the thing is, DPI also can be manipulated in the short term because you can force the sale of a company. You can exit out of a company earlier than you should otherwise. But my main point was...
Sorry, let's define it real quick just for the audience.
Oh, yeah, of course. So DPI is dollars paid in. So like however much you paid in, what multiple of that did you get back? Mm-hmm. And then TVPI is total value. So like, what is it worth? Not only what did you get back, but what is it worth in total? And his point, which is correct, is TVPI can be manipulated. You can different folks mark things differently. Now, real LPs, institutional LPs see right through that stuff. So for the most part, real funds don't have an issue there because we're all marking our top NAV drivers similarly. But his point is totally fair on DPI versus TVPI. Now, I was making a different point, which is if you go back to, so right now, this is his most recent performance, which is actually totally reasonable. If you go back to the original slide that I was responding to, he had a bunch of errors in the slide. So if you go up and scroll up, go back up one more.
Okay.
Yep, and the second one there. So actually, what happened is the second slide that you brought up, or the slide that you brought up, is his revised slide after I criticized this one for his lack of attention to detail. So there's a few things you'll notice here. One is the paid in capital section. That's how much money people paid in, but he has dates listed there. And he talks about how he has such high attention to detail. That's obviously an incorrect thing right there. But then the other thing is the gross TVPI quartile rankings. They're actually just wrong. Like I pulled up the data that he claims it's from, and they're wrong. Like he has himself listed as a top quartile performer, but I pulled up the chart and actually only one of his funds is a top quartile performer, and fund 3 is actually a below median performer. So it was just a fun ribbing.
Just fact check. Social media.
Just a fact check. And then he said I was a buffoon. Claimed that if I had read the subheading, I would have known what he meant. But then, in fact, he actually went back and changed his annual report to reflect what I had written.
That's funny. Well,
so he said I was wrong, but then changed the report anyway.
Watch what they do, not what they say. Well, I can attest. She was not a buffoon, very sharp, thoughtful individual. Look forward to. I think we always run into each other at Money 2020.
Yeah, and other places. Yeah,
and other places. So, all right, we can move on from that. Now, I asked Grok to compare QQQ returns against social capital returns, or kind of more generally. And here's what Grok is saying, right? Grok is saying that, in short, if you invested in QQQ kind of post 2019, you beat venture, and also the earlier vintage years around 2013, of course, 2011, those are stronger. Now that's true for venture as a category too, right? I mean, there's just a growth of capital. Do you want to double click there? And you started in venture before you had so many people and firms and rush into venture. You've seen a lot of it.
Absolutely. And, the more folks there are in the asset class, I think the number of investable companies has not grown as fast as the amount of capital in the space. So that, of course, drives down returns across the board. I think, for all the shit I've given Chamath, his returns are perfectly acceptable. They're not like lights out, but they're good performers. I mean, he's got, I think, 15 to 20% IRRs or something like that. So I think the one thing that people miss, if you compare it to the Qs, is the timing. So to give you an example, I can talk about my own fund. My first fund in 2017, I was a small fund, $15 million. And so it's a 2017 vintage fund. But actually, the way venture works is you don't give me the money in 2017. You give me a little bit of the money in 2017, and then 2018, 2019. And if you look at my overall multiple to today, let's say it's somewhere in the order of 5x. All right, my 2017 fund. So you might say, okay, you might look at that and say, okay, how did the Qs perform over that time? I think I'd probably still beat the Qs, but maybe not by that much. But what you'd miss is my investors didn't give me the money in 2017. They gave me like a third of the money in 2017, and then more in 2018, more 2019, more 2020. And actually, the other thing you'd miss is I paid them back half their money in 2019. So like that you wouldn't have accounted for in your multiple calculation. And so they have that money back and they can invest that in whatever they want. Right. So I think that the comparison to the Qs is one that makes sense, but it's not exactly apples to apples.
Yeah. I mean, you started your career, was that 500 startups?
That was it was the 500 fintech fund. Exactly. Yeah.
Right. So what have you seen around venture and how it's evolved from this cottage industry to these big platform VCs with loads of capital and companies staying private for longer? And like, for example, Stripe. Yeah.
Will they ever go public? Who
Right.
knows? Yeah, it's interesting. So the industry has changed so much in the decade or so that I've been a part of it, and then there was another 4 or 5 years that I was a part of it on the other side as an entrepreneur. So I can speak to that last 15 years or so. Um, One thing is, when I had my company, we were based in Chicago, and we came out to everybody sort of did the Sandhill Road dance, and you might even go to Boston. We went to Boston sometimes. We went to Sandhill Road to fundraise. Now nobody thinks about Boston. That's not,
Boston's off the map. Usually ecosystems grow over time. Like Silicon Alley, New York is a real market. It was dismissed back in the 2000s when DoubleClick was the first
yeah.
kind of win of the category, but it's a real market.
Oh, New York has really come into its own in the last 5+ years. I think COVID was an accelerant for New York. A lot of young people want to live there, and people have built awesome companies there. And for us as fintech investors, it's actually it's our number one market. We're in New York more than San Francisco, even though
wow.
we live in San Francisco. We have an office in New York. We have a couple of people there. So New York has really come into its own. Boston, I think Boston was very conservative historically, and missed the venture community in Boston, missed out on some of the homegrown companies. Obviously, Facebook being the biggest, but several others as well. And so folks kind of just moved on from there, and even some great funds that started in Boston ended up shifting to the Bay Area. Matrix, I think Bessemer had a big Boston office. General Catalyst, of course, basically shifted entirely, but it was entirely based in Boston. I think came out to San Francisco to set up the office not that long ago, and then they invested in the Series B of Stripe, and the rest is history.
Got it.
But you asked a little bit about companies, how the industry has evolved, and companies staying private longer. That's been the biggest change, and that's also a part of why fund sizes are larger. You see, it was very rare. There were very few billion-dollar funds before, but now these companies are staying private longer and longer. Databricks, Stripe, and others, SpaceX, and so what used to be a public markets investment is now a private markets investment. And you have Stripe at $100 billion. And for some of these marquee names, they have many of the advantages that they would have had of going public without some of the downsides. We've made it harder to go public, and it's expensive, and
oversight, compliance, quarterly earnings.
And in some cases, it's annoying too. You have your team focused on the stock ticker, or on the stock, versus what they should be focused on, long-term performance. And so I think a lot of founders are now saying, maybe I won't go public. And that has meant that timelines have changed for venture investors. So, we used to think about getting a return in 7 years, and that's sort of like the timeline of a fund is 10 years. But now the timelines are extended, and every fund that's good has companies that are still going 10+ years on.
Extraordinary. I mean, it's hard to imagine what the world even looks like 10 years from now, given just the acceleration of AI. I mean, how do you feel about the current vintage versus others? I know certainly in say 2022, there was the rise of secondary venture capital and people looking for liquidity. Harvard's looking for liquidity on their private equity investments. I imagine some of that would include venture. It depends how they define and the scope of private equity.
Yep.
What's the LP perception now, given the backdrop of in QQQ, you're getting long performance, right? Double-digit back-to-back years.
I think it should be part of your overall bucket, but the Qs have performed so well that you really should be thinking about outperformance. You don't want to invest in a manager that you think is, going to get you 2x your money. Like, you should be investing in folks that are shooting much higher, and think about that as part of your overall portfolio if you want to include it at all. And I think for most individuals, they probably shouldn't. Um, I think people became enamored with this asset class, but
Mhm.
really, I think a lot of individuals, um, you know, I think like at a certain level of wealth, I think it makes sense to have exposure to venture. But a lot of folks at the earlier, like folks who didn't have a lot of money were asking for access to our fund. And I just told them, like, it doesn't necessarily make sense. Invest what you're willing to lose. Um, and, hopefully you get some outperformance. And we have, fortunately, a track record of delivering on that, which is great. But I think probably like a lot of investors, I'm also wondering, like, are we going to be able to continue that track record?
Right,
Like,
right, right. I mean, you have losers that turn to winners and winners that turn to losers over a 3-year time frame, and like what logo you're putting on the deck to your LP changes depending on the climate. I mean, it's a tough category. It's like Warren Buffett says, make an investment as if you got a punch card and you only got 20 slots. That literally what venture is, depending on the kind of number of deals you're doing. But there's
yeah,
no liquidity on this stuff, so you got to aim as best as you possibly can. What are the primary drivers of your success as a venture investor? Is it valuation, founder selection, thematic selection, waiting for traction? What are the things that have popped for you?
founder selection. I think if I look at my success from that 2017 fund, um, I mentioned one company returned half the fund in 2 years.
Which is kind
Um,
of normal, right, for venture, right? Those lumpy returns.
Lumpy returns are normal, but getting that kind of return so quickly
Well,
is
that's fast.
unusual.
Yeah, that's unusual. That's definitely
That
right.
was,
Right.
and
That's
honestly, it's not like I deserve credit.
hard to repeat that. Yeah.
It's not like something I can ever do again.
Right.
It's
Yeah.
like
You
we
got to get.
had we got lucky. A company, we had an offer to sell the company, and the founder was open to taking that offer very quickly on in the company's journey.
Yeah.
It's rare that that sort of thing happens, um, but I'll say I think that there's actually like again an increased time, an interesting time to invest. Like, I'm surprised we haven't talked about it already on this call, but AI is really changing things remarkably. We're
Hmm.
seeing some of our companies just grow like crazy. Ways that, in the past, in the world of SaaS, there used to be this thing called T3D2, which means once you get to 1 million of revenue, you triple, triple, triple. So you go 1 million to 3 million to 9 million to 27 million. And then you double, and then you're at 52 million, and then you double again, and you're at 100 million. And so that was the 5-year plan to get to 100 million. And that was considered a great success.
Hmm.
That's like, you do that, you follow the T3D2, and you're going to go public. That was how things worked. Now things are different. With AI, some of this adoption is happening so fast. It's like, you have these waves of, if you look at the early data from Google, how quickly they were able to get revenue in the world when people were coming online, or the early folks in mobile, you have something similar happening now. And some of these
Hmm.
AI companies are getting to millions of revenue and tens of millions of revenue and hundreds of millions of revenue much quicker than you could have expected.
Wow.
So we'll see what happens.
Is it because they have a value proposition enabled by the AI, or they can build more quickly with AI, or their operating costs are lower from AI?
It's all the above. So one, I'd say companies are definitely able to build more because of AI.
Hmm.
Just every engineer is more powerful than they were before. Now that also means the competition is more powerful than they
Right.
were. So
Right.
it doesn't
Right.
necessarily just give you a leg up, but um, it's a gives you an opportunity. And then adoption of AI, really what you have to think about is like, who am I solving a problem for? How big is that problem, and what is being solved?
Hmm.
And I think there's just so much exciting stuff happening that you're able to solve a problem for a consumer. It doesn't matter that it's AI. It's just,
Right.
what are you solving?
Right.
And you're able to do that in a way that's better, faster, and cheaper.
Gotcha. So it's speed and value creation. Do you have some examples? Do you see areas or themes that are working, or there's some startups you want to call out that have grown very quickly, focused on AI?
Sure. Yeah. So we have a bunch of companies in the AI space. I'd say a few of them. There's a company called Basis. It's in the AI for accounting space. They sell into large accounting firms and they automate the work of a junior accountant. And there's a high willingness to buy in accounting. There's a
Mhm.
shortage of accountants in this country, and there's no shortage of work. And if you think about accounting, it's a lot of fuzzy data that's unstructured, and if you can structure that data, you can turn it into something that is rules based. And
Mhm.
so Basis, as it says, sits aside your existing stuff and then automates work. So it's, alongside a junior accountant, there'll be a Basis agent. And ultimately it'll only be Basis agents instead of junior accountants.
Fascinating. So it's a productivity enhancement tool for accountants. It's not a displacement play. It's helping them do more work.
Ultimately, it will be a displacement for junior accountants. Like
Gotcha.
right now, it makes them a lot more efficient. Ultimately, it's just going to do that work because people shouldn't be doing that work. Like
Right.
people shouldn't be doing math by hand. People shouldn't be doing accounting work that should be completely automated with 100% accuracy.
Makes sense. Makes sense. Where else are you seeing, rapid traction? Now, this is an example of call it a vertical approach. Now, in the past, this might
Yes,
have been vertical SaaS, but now it's vertical AI.
that's
Uh,
exactly right. Yeah. Another one in our portfolio is called Atlas. The website is withatlas.ai.
okay.
And these guys are revenue automation. So the idea is, you need to get paid, you have a contract outstanding. Um, these guys will automate all of the work it takes to get you paid. And that could mean negotiation, it could mean a bunch of different things. And ultimately, we believe this is going to shrink the world of AP and AR together, and it'll just be one solution.
That's a huge opportunity if you can do that. This company is like was a C2FO. I think it was run by
Yeah,
Sandy Berger.
Andy. Yeah.
Fascinating company. And I think their thesis was that you can go to Walmart, which has they're financing these merchants. Well, actually, they're getting financing. They're getting like net 90 terms and net 30 terms from their own suppliers. But they're in a unique position to underwrite their suppliers because the credit risk is on Walmart. And so, can you create liquidity and financing in that market, knowing that they're going to get paid by Walmart? It's on the Walmart platform. I don't know what of
Exactly.
that, but pretty clever concept. So AR automation, fascinating. So are there certain subsectors are focused on, or is it? I see collections. Is that like consumer lending, fintech?
Not consumer. These guys are focused on enterprise. So think about your um any like Series B plus company that uses invoices and says like, I need to get paid. Um, these guys will automate the work to get you paid. And you can actually, I think you can see it if you scroll down.
Mhm.
Like you can set up basically this intelligent workflow that it will do automatically for you. So you don't have to do anything. You just plug it in and it handles everything else.
Right, right. Yeah, look, who doesn't want to accelerate revenue, right? Easy value proposition. We're going to help you make money quicker, and you don't have to hassle your customers. Let the AI take care of it, right? So, kind of a drip campaign all automated with AI. Uh, Very cool. This is an example of a horizontal in this case that kind
That's
of run
exactly right.
the category here. And I guess you have like your startups are adopting this, or do you have enterprise adoption around this, or?
Right now, it's primarily like startups or tech companies. I think over
Okay.
time, there's a tremendous opportunity for non-tech companies. Like every company wants to get paid faster,
Right.
whether you're building widgets in Kansas or selling software in San Francisco.
Got it. Got it. Have you seen anything in the fintech space? I know you're very active and a lot of history in the fintech category. Have you seen AI innovation there? What does that look like?
Yeah, I would say a lot of it is behind the scenes, but you're seeing a tremendous use of AI for anti-fraud and compliance use cases.
It's always fraud
You're
and compliance, isn't it? I feel like it's always
Yeah,
fraud. Every year, it's
it's
fraud. Like
it's
you got
such
the
a
money,
big problem that I think people probably underestimate how big the problem is. But yeah,
right?
absolutely.
It's like every year. I know we go to Money 2020. It's like a reunion. I think I go there because I just enjoy seeing people I haven't seen in a long time. They all congregate there, and when you walk the expo, there's like 12 fraud and compliance solutions. Look, it's a big category. Fraud
At
is a lot of
least, at
fraud,
least.
at least, right? And there are different kinds of compliance. So it's a big ocean to swim in. But I kind of feel like maybe the startups today are disrupting the startups from like 5 years ago.
Yeah,
Uh,
that's
but
that's always how it goes, right?
exactly right. Um, Very cool. So tell us more about, if we can shift gears here, unless there are other thoughts on AI. Have you seen it AI from like the operator entrepreneurial perspective, and how, what you shared here is really value proposition, right? Like here's an
Yeah.
underserved market, strong value prop, pain point, get revenue, cut costs, get productivity. Uh, do you have any anecdotes around how entrepreneurs are just executing more swiftly, and what tooling or best practices and
Yeah.
before and after?
Yeah. Check out this company, deck.co.
Okay. Deck.co. Process payments, data collection. I'll share my screen here.
Yeah, share your screen and I can
There we
talk through
go.
it a little bit.
Yep.
Okay, so what these guys do is um, they you're familiar with Plaid, where you can
Yep.
user
Plug
with
in.
user permission, you can plug in and get information from your bank. So
Yep.
these guys are like Plaid, but from any website. So as an example, telecom portals, they can log into your Verizon travel, they can log into your like United Airlines. And for any
Oh,
company, they can extract relevant information and serve it
wow.
to a third party as an API.
Oh, that's wild. Any company that can log in and access this data, like an applied, this company is going to do really well.
Yeah, it's a pretty cool
Yeah.
product and application.
Huh.
And we didn't even know all the crazy ways that people might use this thing. Like when we invested in this company a year and change ago, actually no, not even a year ago. Um, the business was basically utility company data, and there actually had been success in this category before. Another company, simply with utility data, had come to a good outcome. But what they were doing is they literally had like people in India, like hundreds of people in India, manually doing this work.
Mm-hmm.
And so these guys were just like, we can do this, we can build this automatically.
Huh.
Um, and then they announced that they could do it for other websites, and the uptake has been crazy. So like the stuff that we've seen people use it for is wild. There's like I mean, here are some, like, get data from HubSpot, you can read and write, extract YouTube history, you can one cool
Yeah.
use case is music royalty information. So like Justin Bieber needs to know if he got paid the right amount from the royalty companies. So there's a product that like uses Deck to log in and check to make sure that it's accurate. So there's all sorts of cool
Yeah.
applications that I never would have thought of, at
I
least.
like this one. This is a good infrastructure play that developers can build on top of. And once you're in the developer tech stack, you're never going to move away from this. Just like if you build on Stripe or Datadog or some kind of cybersecurity. I mean, yeah, we have clients with assets all over the place. If we had a tool like this to log in and aggregate account information and present it in a single dashboard for them, it would make everyone's life a lot easier.
I'll connect you.
Yeah, no, this is a super interesting. So AI is real. You're seeing real solutions. These companies are growing revenue very quickly. What are you seeing in terms of valuations? Are things getting nutty out there? Is it like how many term sheets per deal, et cetera?
Things are definitely getting nutty.
Okay.
I'd say like, valuations. First of all, as a venture investor, I'm always complaining about valuations. There's never a time where I'm happy. I'm like, oh, valuations are where they should be. No,
the valuations are too damn high. Yeah.
It's all the valuations are always too damn high. But we let's see. If you look at the Carta data, I think valuations, even though 2021 was a crazy moment where valuations seemingly were the highest, at seed, valuations have only crept up from there.
Wow.
Which is kind of crazy. This is so look, talk about this tweet. So in January, we had 8 companies. I wrote this on February 1st. The crazy thing is, in the next week after I wrote this, the next week and a half, maybe 2 weeks, we had 2 more. So actually, it was within a 5-week period, we had 10 companies raise follow-ons, which is crazy. Like the most I think before that was like 3. So it was a sign to us that fintech was back. Actually, one funny situation is less than a year ago, a multi-stage investor had a fintech team, and they actually broke up their fintech team. They said, we're not really doing fintech anymore. And then, fast forward 6 months, fintech is really back at the forefront, and then they're all back doing fintech deals.
Right. Yeah. Fintech is like high beta in venture capital. It's like really hot, or that no one wants to touch it. And it takes different forms, and from lending to payments and crypto, and then all these things fall in and out of favor. So
that's right. At any given time, there's something that has just fallen out of favor, another thing that's coming into favor. Fortunately, fintech's such a broad category,
right,
that there's always something interesting going on. There's always something coming into favor.
Fair enough. Yeah. This is some data from Carta. Carta does a fantastic job just summarizing all the deal volume and the valuations and the dollars raised by different vintages. So I was surprised to hear that you're seeing valuations are higher than 2021. So if you're an LP, where do you position? If you have the sequence from pre-seed all the way to late stage venture, and obviously you're focused on early stage, but if you put your independent hat on, if you're an LP, where would you want to focus?
Yeah, it's a good question. So I think pre-seed, it's hard to not talk my book here, but
sure.
I feel like we have the best risk reward overall. I think at the A, things get super competitive. So like when a company is doing well in our portfolio, they'll have, to your earlier question, they'll have 5 or 6 or 7 term sheets. And, we are back at a point where companies that we lead around into, the next round has a triple-digit number, like it's in the hundreds in many cases.
Walk us through like the metrics from pre-seed, seed, Series A in terms of revenue, traction, or users that show the graduation, and what's the corresponding valuation bump that you see?
It's really hard because it doesn't, unfortunately, like it doesn't really work linearly that way. It's really more like we have companies that do, actually, real example, we have a company doing north of, call it 50 million, it's well north of 50 million of revenue in our portfolio. And if they went out to raise today, it would probably be at a lower valuation than one of our AI companies that is doing $1 million of revenue.
Wow. That makes no sense. I'd go for the $50 million company. If they have that good growth, I'd bet on that one.
They do. Yeah, it's crazy. It's crazy. So the numbers are all over the map, but what I'd say is you can think about pre-seed as being, call it 5 to 10 million valuation, 5 to 12 maybe.
Oh, those are
Yeah,
good
about-
valuations. 5 to 10, that's not. If you can get a $5 million valuation pre-seed with a quality team, though, that's the key.
Yeah,
With a quality team, because you have no revenue, no traction.
no
So
anything. Yeah, just a
very
team.
high risk. You just got a story and a dream and a team. Right.
So, but you know, more like closer to 10 than 5.
Okay.
You know.
Okay.
And then your seed rounds are then like 12 to 25. Although there are people calling seed rounds, 50 or 70, or
So
there's the multi-billion-dollar safe super intelligence round.
you're right. Gosh, that's insane. Seed at a $50 million. I mean, inflation. So, gotcha. So you're seeing bananas like valuations for AI startups with revenue. So at $1 million revenue, can you show what multiple is that? Like, what's the right way to? What comp would you look at?
There's no comp on a multiple basis,
Okay.
but what I'd say is like once you have, because once you scale to a certain level of revenue, we're seeing some AI companies get to like 50x. Crazy. I think ultimately it settles down to 25x or something in that range for those growth companies. But right now we're still seeing like 50.
Got it. So 50x like price of sales on last 12 months revenue. And is that transactional or recurring, or doesn't matter?
It doesn't matter. There's both, but if it's transactional, that you can have a reasonable belief that it will be recurring.
Yeah, interesting. Have you seen your startups feel constrained in terms of where AI is today, in terms of pricing, access to GPU, or the technologies available?
Yeah, I would say a little bit, but overall, I think they are. Our companies are mostly at the application layer, and they're able to get what they want from the provider.
Got it. So they have the data and data processing. I mean, the more advanced AI applications, like around avatars, for example, you get 8-second video clips. And if you want the voice to be in tune with the video, there's only 1 or 2 platforms can do that, at least now. So there's still limitations, right? If you're doing data handling, right, data processing, and interpretation, report writing, then the current LLMs are fine. Are you seeing any issues around hallucinations or any other blockers?
You're seeing a lot less of that, and we're able to, like a year ago, that was a real problem. Now it's not that big of a problem.
Yeah, no, I agree. We agree. Any trends around where you're seeing adoption or churn on the toolkit? Are people migrating from AI or OpenAI to Anthropic or Grok, or who's pulling ahead? Is Google's agentic AI relevant here?
I think you have most people using multiple, and people are saying, like in our founder Slack, you have people talking about it, and people are saying, okay, yeah, like for OCR, use Mistral. For this other thing, use Gemini. For this other thing. So it's hard, like the frontier models are changing so rapidly, which one you want to use for what, that people are just using multiple, and they know for this thing I want to use this, for that thing I want to use that, but there's no loyalty from what I can tell.
Got it. Fascinating. No, I agree. I mean, there's a lot of churn. Like whoever's got the latest mousetrap, you swap out the API key and you get going.
Yeah.
It's going to be interesting. I mean, my view is bet on the picks and shovels infrastructure layer. It's hard to pick a winner, especially when the valuations are high at the, in terms of the big LLM foundational models. Any other thoughts on AI and venture and startup land and founder adoption?
No, I think we covered it.
Okay. Let's shift gears to AngelList. So AngelList, and my sense is like one of the premises is that they're seeking to disrupt venture capital. by bringing entrepreneurs and LPs together on a common platform. Obviously, the founder, one of the co-founders, Neville Ravikant, he's very well known on Twitter, early investor in Uber. He's kind of like a monk.
Yeah, very much like a monk.
He's got an incredible reading list, I have to say. I've gone through something like, yeah, he's got very good taste in what he's reading. But how do you see AngelList today versus its mission? And is it an attractive platform for VCs or SPVs to raise deals from? Is it changing how venture capital is done today?
Yeah, I think it's definitely evolved from the days where it was literally a list of angels. And actually, back in the day, we used, or fee fighters, we used AngelList to raise money. And it was Neville sent it out to a bunch of friends. That was the angel list. The product has evolved, and now I think the big opportunity is in being a fund administrator, and a lot of funds run off of AngelList. They do have a strong syndicates business as well, and they have both, good revenue as well as underlying carry in some of these vehicles, which is pretty nice. Makes it an interesting business. It's hard to value.
Right, exactly. Yeah, it's pro-cyclical revenue, and at the top of the market, you see a lot of bad deals get done, and that's just the nature of that kind of business, right? And
exactly.
But I do think that like these new vehicles for connecting capital to entrepreneurs are continuing to emerge. You see that with like Republic and crowdfunding and the Jobs Act, Reg CF, and then on decentralized assets, you're seeing that also. Have you seen, what are your view on, I mean, as a VC, your standard line should not be in favor of like crowdfunding deals. By the way, it's generally good ideas, and probably LP, like get someone to curate, underwrite, make sure the valuations are due the diligence. But do you have any thoughts on, crowdfunding platforms like Republic or your CoinList and others?
I think like there's a place for each of them. I think, if you just invested across the board in AngelList, you probably didn't do well. But if you went after the syndicates of people who do a good job of curating, you probably did do really well. So I think even with each of these, you can't just have everybody put everything up there. That's not going to be good for the folks who are investing in these things. I think curation is a big part of the game.
What about community? I mean, it seems like community and capital are coming together, right? So like the All-In pod, they've got a conference. They built a conference business. They're bringing physical people together. They're attracting LPs through that. I presume they're creating content around that. Money 2020 is like the fintech venture capital conference of the universe here. But I think these other and digital assets have brought together community and
so many.
Good, yeah.
There's so many conferences. I feel like the digital assets folks are just like going from one place to another.
Right. And there's one almost every other day, it feels like. But it seems like, that could be the next model. I'm not sure how to articulate it, but this idea of connecting capital and community and social media.
I think that's right. And I think, well, first of all, like our friend Howard Linson.
No, it's a great example. It's Oktoberfest, community.
Oktoberfest,
right.
StockTwits, all that kind of stuff.
Right.
But yeah, I think there's going to be more and more opportunities for this kind of stuff, and people, it's become a real interest for a lot more people than it was 10, 20 years ago.
Yeah, no, I agree. Great. Well, I think we covered a lot of ground. Any closing thoughts on, what you see ahead in the next few years, forward-looking observations or investment wisdom you want to impart on the audience?
No, this has been great. I'm excited for the future of the asset class and for fintech in general. And it's been super fun. I think the asset's going to continue to grow. The way we think about fintech, by the way, is like from a macro perspective, financial services are 20% of global GDP, and a lot of that is not yet digital. And as it becomes more and more digital, there's just more and more opportunity.
Fair enough. There you go. And how can people follow you? Obviously, you got a big presence on Twitter.
Yeah, Twitter's easy, at Pitdesi, Pitdesi. LinkedIn or anything else is fine too.
Terrific. Excellent. Thank you, Sheel. We'll have to do it again. I'll see you at Money 2020 at the very least. You got some fans here. So good stuff. Make
Absolutely.
it a good one.
Thanks, Ram.
Take care, Sheel. Be well now. Bye-bye.
Bye.